Good day everyone, my name is Koja with metric number 300619 and from Group 1. So I'm going to start the presentation with some brief introduction about KPMG Netherlands. So firstly, KPMG Netherlands is one of the oldest Big Four firms in Netherlands. As you know, Big Four firm consists of Deloitte, PwC, EY and KPMG. So because KPMG Netherlands has actually rooted in Netherlands for over a century, so it's one of the oldest accounting firm I can say. And then KPMG Netherlands has a strong international exposure as it audits and has a lot of US listed company as their client. So they are monitored by the AFM of Netherlands as well as the PCAOB of the United States. And then KPMG Netherlands also heavily emphasizes on training because they require their employee to complete mandatory trainings and exams on ethics, which this becomes the main issue we will discuss in this presentation. And then KPMG Netherlands also active in some of the ESG and sustainability practices, as the firm will do a lot of climate-related advisory work as they are part of their business activities. And then KPMG Netherlands, lastly, also is a highly public scrutiny company because of its reputation. It is more regularly reviewed and discussed by the public as well as the authorities. Alright, so now I'm going to briefly talk about the case context of the ethics breach of KPMG Netherlands. It all started with a mandatory framework implemented by KPMG Netherlands, which involved an annual internal training as well as an online assessment in order to safeguard the professional competence of their staff, of the auditors, to make sure of the auditors are capable and they are able to catch up with the latest auditing standards, the professional industrial practices updates. So to ensure their auditor meets the quality control. And during these assessments and training, some misconduct happens because the employees from all seniority levels has been engaged in a systematic answer sharing for the internal exam. So these acts compromise the integrity and ethics as well as the independent assessments, which is critical to the auditors. So the scale of this ethical breach is quite large, I would say, because it involves over 500 professions, including the top level management and some lower level auditors staff. So in response, the regulatory authorities, because this issue is discovered by whistleblower during the year 2022, so the authorities have launched a joint investigation by the PCAOB and the AFM of Dutch to investigate in this case, and it results in severe sanctions in terms of penalties towards KPMG Netherlands and give them a reputational damage as well. Now, moving on to the timeline overview, we are looking at this case at 3 phases. The first phase will start from the year 2017 until mid-2022, which covers the initial discovery as well as the whistleblower. And then the second phase covers the mid-2022 until the year 2024, which includes investigation and regulatory escalation. And the last phase is the year 2024 until present current, which covers sanctions, remediation, and some continued oversights from the authorities. Alright, the first phase, initial discovery and whistleblower, indicates that this incident happens due to a widespread answer sharing for mandatory ethics and independence audit exams. And then this answer sharing, it involves staff across all levels via informal messaging networks. And the internal monitoring systems of KPMG Netherlands fails to detect this misconduct, and then this issue only surfaced when a whistleblower reported in the mid-2022. For the second phase, investigation and regulatory escalation, this involved a joint investigation by AFM of Dutch and PCAOB. And then, due to their investigation, they have uncovered that hundreds of employees, including senior staff, are found involved in this ethics breach incident. And then, regulators examine both cheating and misleading disclosures to the authorities. And lastly, this finding highlights the failure in audit quality control and leadership tone. Lastly, let us move on to the final phase, which is sanctions and continued oversight. So PCAOB has imposed a heavy fine amounted to $25 million towards KPMG Netherlands, and some of the senior leaders involved in this incident has faced professional bans, and KPMG Netherlands is also required to strengthen their examination control and their whistleblower system. Lastly, they are under regulatory supervision by AFM and PCAOB for a certain period in the future.
In this case, several key ethical issues were identified that significantly undermine audit quality and public trust. First, integrity violations occurred when employees, including staff and partners, engaged in improper answer sharing during mandatory internal training exams on audit standards, ethics, and independence. This dishonesty behavior meant that exam results no longer reflected actual employee competence, increasing the risk of weak professional judgment in audit work. Such conduct directly contradicts the PCAOB's expectation that audit firms uphold integrity to maintain investor confidence. Second, there was a breach of professional behavior and due care. IESBA standards require auditors to maintain professional competence and apply due care. However, cheating in training assessments undermines deep understanding, particularly in critical areas such as ethics and independence, thereby increasing the risk of audit error and reduce audit quality. Third, the case reveals a culture of misconduct within the firm. The improper answer sharing persisted over a 5-year period from 2017 to 2022, indicating that unethical behavior had become normalized rather than treated as isolated incidents. This highlights systemic cultural weakness and contributes to the erosion of public trust in the audit profession. Fourth, regulatory non-compliance was evidenced. Despite early warning signs in 2020, KPMG Netherlands failed to investigate or report the misconduct until a whistleblower came forward in 2022. During the PCAOB investigation, the firm provided inaccurate representations even though senior leadership was later found to be involved. This reflects serious leadership accountability failures. Finally, the case demonstrates a failure of internal controls over training and ethics. Weak monitoring and enforcement allow widespread misconduct to continue unchecked, reinforcing unethical behavior and negatively affecting real audit performance. Following the identification of key ethical issues, this section analyzed the major stakeholders affected by the misconduct at KPMG Netherlands. First, KPMG partners and employees are among the most directly affected stakeholders. Those involved in improper answer sharing face disciplinary actions, reputational damage, and potential career consequences. More importantly, even employees who are not involved may suffer loss of public trust, as the unethical behavior occurs within the firm as a whole. This situation undermines their professional credibility and raises questions about the integrity of the firm's workforce. Second, clients who rely on high audit quality are significantly impacted. Weak internal controls and compromised training integrity increase the risk of low-quality audit work. As a result, past audit opinions issued by KPMG may be questioned, reducing confidence in the reliability of those audits. Clients may incur additional costs and time for re-audits or enhanced reviews. Furthermore, if misstatements go undetected, clients' business reputation and stakeholder confidence may be severely damaged. Third, the auditing profession in the Netherlands and across Europe is also affected. High-profile ethical failures at a major audit firm can lead the public to question whether similar unethical practices exist across the profession. This may prompt stricter regulatory scrutiny, increased monitoring, and heavier compliance requirements for audit firms, which increase operational burdens. Finally, investor and capital market participants face increased financial risk. Investors rely heavily on audited financial statements when making investment decisions. When audit integrity is compromised, confidence in financial information declines, potentially affecting market efficiency, fairness, and stability. A widespread loss of trust in audit reliability can weaken investor confidence and harm the overall effectiveness of capital markets.
Next, I'm going to present the root cause analysis. The issue at KPMG Netherlands mainly stemmed from the several root causes in their organization culture. First, exam cheating involved not only junior staff but also senior management, showing that ethical values were not strongly enforced. Many employees treated training assessment as just a formality, so informal norms and peer pressure became more influential than the firm's official codes of ethics. Second, there was strong pressure to meet the internal KPIs. Training completion and audit readiness were closely linked to promotions and also audit assignments, which led some employees to focus on more finishing the test than actually learning from the test. This KPI-driven environment and also unintentionally encouraged the shortcuts, making the unethical behavior more common. The third root cause will be the weak ethical leadership worsened the situation. Regulators found that even senior leaders, including the former of the head of assurance, share the exam answers. When leaders break the rules, it signals to the employee that such behavior is acceptable. This was further compounded when inaccurate information was given during this investigation, which eroded the trust and also the accountability. The following root cause will be there was an overemphasis on compliant documentation rather than real learning. Employees often saw the training as a box-ticking exercise, so passing the test became more important than understanding the material. So this made the shortcuts like answer sharing more likely and also easy to justify. Finally, KPMG lacked proper monitoring of its training system. Cheating went on from 2017 to 2022 without being detected. Even when similar issues arose in 2020, there was no follow-up was done. This failure in oversight created an environment where employees feel misconduct could go unnoticed. Next, I'm going to present about the regulatory and also professional standards implication from the KPMG issue. The KPMG Netherlands exam cheating is a clear violation of the International Federation of Accountants (IFAC) Code of Ethics. Integrity was compromised as employees, including partners, share and use the exam answers. Objectivity was affected because the staff passed the competent test without the proper learning, which impacted their ability to make unbiased judgment. Professional competence and due care were also breached, as employees lacked the skill required for high-quality audits. Finally, professional behavior was violated, undermining the public trust and damaging the reputations of the profession. The misconduct also reversed failures in quality management standards, specifically International Standard on Quality Control 1 and also International Standard on Quality Management 1. KPMG's system failed to detect the widespread cheating between 2017 and 2022, and earlier reports in 2020 were not properly investigated. These gaps highlight the weaknesses in risk assessment, ongoing monitoring, and overall quality control measures. The AFM identified serious cultural and governance weaknesses, noting that the top management also involved in the misconduct. The Public Company Accounting Oversight Board (PCAOB) responded with a 25 million fine, one of the largest ever for a non-US audit firm, and required additional compliance measures. The AFM also strengthens its oversight. This action reflects the regulator's expectation for strong ethical culture, robust the internal control, and clear responses to the malpractice. Finally, the KPMG Netherlands case reflects the broader trend seen in other Big Four firms worldwide. For instance, EY US faced massive cheating in ethics and CPA exam in 2022, resulting in a 100 million SEC fine. While PwC Australia 2023 tax data led to the partner removals and reputational damage. Common themes include the weak ethical culture, the leadership failures, and the inadequate detection system. These cases underscore the urgent need for stronger integrity, accountability, and quality management across the audit profession.
In this part, I will apply 4 ethical theories to analyze the misconduct at KPMG Netherlands, each offering a different perspective on why the behavior was unethical. The first one is deontology. Deontological ethics evaluates behavior based on whether moral and professional duties are fulfilled, regardless of consequences. Auditors have a fundamental duty to protect the public interest, maintain independence, and uphold integrity as reinforced by the IFAC Code of Ethics. In the KPMG Netherlands case, employees cheated on internal training and compliance examinations designed to ensure professional competence, ethical awareness, and professional skepticism. From a deontological perspective, cheating is a clear breach of honesty and truthfulness. Even without immediate audit failure, the act is ethically impermissible because it violates universal moral rules. Additionally, partners and senior members failed in their duty of care by not detecting or preventing the misconduct, reflecting a failure of ethical stewardship. The next one is utilitarianism. Utilitarian ethics assesses actions based on their consequences for the greatest number of stakeholders. Employees gain short-term benefits such as passing mandatory exams, meeting performance targets, and avoiding delays in promotion or workload. However, these gains cause significant long-term harm, including reputational damage, regulatory sanctions, and loss of public trust. Affected stakeholders include honest auditors, clients, regulators, and society that relies on trustworthy financial reporting. Thus, from a utilitarian perspective, the overall harm outweighs the benefits, making the action unethical. The third one is virtue ethics. Virtue ethics focuses on moral characters rather than rules or outcomes, emphasizing virtues such as honesty, integrity, moral courage, and responsibility, which are essential for auditors. The cheating behavior at KPMG reflects a lack of these four virtues, showing that some employees were willing to compromise ethical values under pressure. The widespread nature of the misconduct indicates a deeper organizational issue where the firm's culture may have prioritized performance and efficiency over ethical character development. Virtue ethics also stresses the role of moral examples, particularly leaders and partners. When leadership fails to model integrity or address ethical breaches, unethical behavior can become normalized. The last one is justice and fairness. Justice and fairness theory evaluates where the actions and outcomes are equitable. Employees who cheated gained unfair advantages such as promotions, work opportunities, and perceived competence, while honest employees were disadvantaged. This violates distributive justice, as rewards were not based on merit and procedural justice, as assessment rules were undermined. Fairness also extends to clients and the public who expects auditors to have verified competence and ethical judgment. Compromising exam integrity reaches this fairness out to external stakeholders. Next, this part discusses the corporate governance failures that allowed the misconduct at KPMG Netherlands to occur and persist over several years. Corporate governance refers to the systems, structures, and processes with which organizations are directed and controlled. In audit firms, effective governance is crucial to protect audit quality, ethical standards, and public trust. The first one is internal governance weaknesses. The breach reveals significant weaknesses in KPMG Netherlands' internal governance and control system. Compliance training and assessment systems failed to detect repeated cheating over an extended period with no robust mechanisms to verify exam integrity or identify irregular behavior. These weaknesses reflect failures in internal oversight, internal audit functions, and ethical compliance monitoring. From a governance perspective, internal controls were ineffective in preventing, detecting, or responding to ethical misconduct, allowing it to continue unchecked. The next one is responsibility of leaderships and partners. Leaderships and partners hold ultimate responsibility for setting ethical expectations and and reinforcing accountability, often referred to as the tone at the top. In the case, leadership failed to reinforce a strong culture of ethical accountability. Senior leaders were either unaware of the misconduct, indicating inadequate supervision, or aware but failed to act, suggesting tolerance of unethical behavior. Both situations represent a breakdown in leadership responsibility and corporate governance, where unethical behavior may be perceived as acceptable or low risk. The third one is failure in ethical training and compliance oversights. The Cheating on Ethics and Compliance exam highlights a fundamental failure in the design and enforcement of ethical training. Ethical training is meant to reinforce professional values and ethical judgments, but in this case, it becomes a box-ticking exercise rather than a meaningful governance tool. Weak monitoring allowed employees to share answers and bypass requirements, while the compliance unit failed to maintain integrity controls over assessments. This shows that compliance oversight mechanisms were either poorly designed or poorly implemented. The fourth one is audit committee and board oversight limitations. Audit committees and supervisory boards are responsible for overseeing audit quality, ethical standards, and risk management. At KPMG Netherlands, oversight bodies failed to identify red flags or conduct deeper reviews of compliance and training systems. This points to weaknesses in governance reporting, escalation channels, or community independence. It also raises concerns about whether risk governance frameworks were effectively integrated with human capital oversights, particularly in monitoring ethical behavior and professional competence. The last one is whistleblowing cultures issues. The misconduct continued for an extended period without early internal reporting, indicating serious weaknesses in the whistleblowing culture. Employees may have been unwilling or afraid to report wrongdoing due to fear of retaliation, lack of trust in reporting channel, or belief that management would not act. Effective ethical governance requires safe, confidential, and credible whistleblowing mechanisms, and the lack of early disclosures suggests these were weak or not trusted. This reflects deeper cultural problems within the organizations and highlights the need to foster an environment where ethical concerns can be raised without fear.
Assalamualaikum and hi, my name is Muhammad Shazami Yahya. My metric number is 300738. Now let's move to broader implication for the global audit professions. Firstly, impact on trust toward Big Four firms. The ethics violation at KPMG Netherlands significantly weakened trust toward the Big Four firms. According to the case, hundreds of the employees across multiple levels, including senior leaders, were involved in sharing answers for compulsory ethics and competency exam over several years. This raises serious concerns among stakeholders about whether such misconduct is isolated or reflect deeper culture and governance problems within global audit networks. Since Big Four firms audit major listed companies worldwide, any ethical failure directly damages public confidence in their integrity, independence, and professional ethics. Secondly, the scandal has caused serious damage to audit credibility. The manipulation of ethics and competency tests raises doubt about whether auditors generally possess the professional knowledge and skills required to perform high-quality audits. Exam integrity is closely linked to audit quality because training ensures auditor understands ethical standards, independence rules, and technical requirements. When training is compromised, users of financial statements may question the reliability of audit opinions, leading to reduced confidence in financial reporting at both national and global levels. Next, the case has resulted in increased regulatory scrutiny in both Europe and the United States. Regulators such as the PCAOB and the Dutch Authority for the Financial Markets view the misconduct as a serious threat to audit quality and public trust. As a result, regulators are expected to conduct stricter inspections, impose heavier penalties, and demand greater transparency from audit firms. The case also encouraged closer cooperation between international regulators, meaning global audit networks will face higher compliance pressure across jurisdictions. Finally, the scandal has major implications for global training and examination system within audit firms. The case imposed weaknesses in how training and exam were monitored, allowing misconduct to continue undetected for years. In response, audit firms may introduce supervised or stronger digital monitoring and more frequent assessments. There is also a clear shift toward training models that emphasize real competence, ethics judgment, and professional behavior rather than simply achieving high pass rates. Next part is reforms and remediation measured by KPMG Netherlands. First, action taken after these scandals. After these scandals was exposed, KPMG Netherlands took immediate corrective actions. The firms launched an internal investigation to determine the extent of the misconduct and identify individuals involved. It fully cooperated with regulators during the investigations and publicly acknowledged failures in supervision and internal controls. Disciplinary actions, including terminations and sanctions against senior personnel, were imposed to demonstrate accountability. Additionally, monitoring and compliance systems were strengthened to reduce the risk of recurrence. Secondly, changes in governance controls and trainings. KPMG Netherlands also introduced significant changes in governance, internal controls, and training systems. Stronger controls were implemented over internal and ethics examination to prevent answer sharing and manipulations. Training programs were redesigned to focus on genuine learning, ethical understanding, and professional competence instead of merely passing exams. These reforms were aligned with ISQM 1 quality management standards, emphasizing risk assessments, ethical behavior, and continuous monitoring of audit quality. Third, cultural transformation initiative. Beyond technical controls, KPMG Netherlands recognized that the issue was culture in nature. Leadership emphasized a stronger tone at the top, reinforcing the importance of integrity, honesty, and professional responsibility. Employees were encouraged to speak up about ethical concerns, and the whistleblowing policy was strengthened by guaranteeing anonymity and protections. The firm also aimed to reduce performance pressure and discourage shortcuts by shifting focus toward long-term ethical behavior rather than short-term compliance targets. Lastly, evaluation. Are the measures sufficient? Although these reforms are positive and necessary, the case raises questions about whether they will lead to lasting change. Similar ethics scandals in other Big Four firms suggest that this problem may be systematic across the audit professions. Long-term success will depend on consistent leadership commitments, effective enforcement, and continuous regulatory oversights. Stakeholders such as regulators, clients, and investors will require clear evidence of sustained culture change and improved audit quality before full trust can be restored.